Here's what you need to understand. Japan is not the story because it is dumping treasuries today. Japan is the story because its currency is forcing policymakers into a corner. Today, Japan's finance minister said Tokyo is ready for decisive action around the 160 yen per dollar line, and Japan and the US have already tightened exchange rate communication. At the same time, Treasury data show that Japan's holdings of US Treasuries reached $1.239 trillion in February 2026, the highest level since February 2022. That is the signal, not panic, pressure. Because when Japan has to defend the yen continuously, it can end up selling part of its Treasury holdings, which can push US yields higher. Reuters laid out that mechanism directly in January. Continuous yen intervention would likely require Japan to sell some of its US Treasury holdings, and that would matter for American borrowing costs. Most people miss the pattern because they look at the headline and stop there. But the deeper pattern is older. In 2015, China was under pressure from yuan depreciation, and Reuters reported that it was selling US Treasury bonds for that reason. That is where the comparison becomes serious. When a major foreign holder turns reserves into defense, the dollar does not get a quiet warning. It gets a visible one. What happens next is the real story. If Japan only talks, markets treat it as noise. If Japan has to act, the pressure moves from the yen into US rates, mortgage costs, and global risk pricing. So the question is not whether Japan matters. The question is whether this is the first sign of a bigger dollar problem. And that is where this gets serious. Here's the sequence most people are missing. The pressure did not start this week. It built quietly as the gap between US and Japanese interest rates widened to extreme levels. The Federal Reserve held rates above 5%, while the Bank of Japan stayed near zero for years. That spread created a simple trade. Borrow cheap yen, buy higher-yielding dollar assets. Repeat at scale. The result is visible. The yen weakens, capital flows out of Japan, and US assets, especially treasuries, absorb that flow. But this is where the pattern begins to turn. As of this week, the yen is hovering near the 160 per dollar level, a threshold Japan has historically defended. The development that matters right now is not just the exchange rate, it is the signaling. Japanese officials are no longer tolerating gradual depreciation. They are preparing for intervention. Here's what the data actually shows. Japan still holds over $1.2 trillion in US Treasuries. That means any defense of the yen has a direct transmission mechanism into US markets. Selling dollars to buy yen does not happen in isolation. It requires liquidity, and that liquidity often comes from reserve assets. The pattern is clear. Every time a major economy defends its currency under pressure, it eventually taps reserves. China did it in 2015. The UK did it during the pound crisis. Emerging markets do it routinely. The difference now is scale. Japan is not a marginal player. It is one of the largest holders of US debt in the world. But here is where things shift. The US is no longer in a low-rate world. Treasury yields are already elevated, government borrowing is accelerating, and demand from foreign buyers is no longer guaranteed. So when Japan signals intervention, the market is not asking if they can defend the yen, it is asking something more important. What happens to US borrowing costs if they do? And this is the part most analysts are missing. Because the surface story is currency defense. The real story is global liquidity tightening at the exact moment the US needs buyers the most. Hold that thought, because what comes next changes the entire structure of this situation. Here's what actually happened, step by step. First, the yen pushed toward the 160 level against the dollar. That is not random movement. That level has historically triggered action from Tokyo because it signals accelerating capital outflow and loss of currency stability. Second, Japanese officials shifted their tone. Not gradual, not cautious, direct. They signaled readiness for immediate intervention. That tells you internal thresholds have already been crossed. Third, coordination channels with the US Treasury Department were activated. This matters, because currency intervention at this scale does not happen blindly. It is monitored and sometimes quietly aligned to avoid disorder in global markets. Fourth, markets reacted instantly, not in headlines, in pricing. Treasury yields edged higher. The dollar paused. Currency volatility increased. Subtle shifts, but the pattern is there. Now here's the mechanism most people never see. When Japan intervenes, it sells dollar-denominated assets to buy yen. The cleanest, most liquid asset it holds at scale is US Treasuries. That means even a partial intervention introduces selling pressure into the US bond market. And this is where the chain reaction begins. More supply of Treasuries, yields move higher. Higher yields, borrowing costs increase. Higher borrowing costs, pressure on housing, credit, and business investment. That entire chain can start from a currency defense thousands of miles away. But this is where the story changes. Japan is not in crisis, not yet. Its Treasury holdings just hit multi-year highs. That means this is not forced liquidation. This is strategic positioning under pressure, which creates a different kind of risk. Because when a strong holder starts adjusting, not collapsing, markets tend to underestimate the move. Most people think in extremes, crisis or stability. But the real shifts happen in the middle phase, when policymakers start preparing, not reacting. And this is the part that matters. If Japan only signals, nothing breaks. If Japan intervenes lightly, markets absorb it. But if pressure continues for weeks, not days, the scale changes. And once scale changes, the impact moves beyond currency markets. It moves directly into U.S. financial conditions. What happens next is the real story, because this is no longer just about Japan. It is about how resilient the U.S. system is when one of its largest external buyers becomes a potential seller. This is where it gets serious. Japan is not just another foreign holder of U.S. debt. It is a stability anchor in the global financial system. When that anchor starts adjusting behavior, even slightly, the entire structure feels it. Here's what you need to understand. The U.S. relies on continuous demand for treasuries to fund deficits that now exceed $1.7 trillion annually. That demand comes from three primary sources: domestic institutions, the Federal Reserve, and foreign holders, with Japan consistently at the top of that list. So when Japan faces currency pressure, it is not just managing its own economy. It is indirectly influencing how expensive it becomes for the U.S. to finance itself. The pattern is clear. Every time foreign demand weakens, even temporarily, yields move higher. Every time yields move higher, financial conditions tighten across the economy. Mortgage rates adjust within days. Corporate borrowing costs follow. Credit card interest rates climb shortly after. And this is happening at a very specific moment. U.S. Treasury issuance is rising. The U.S. Department of the Treasury is increasing supply to fund deficits, refinance existing debt, and support ongoing fiscal commitments. That means the system needs more buyers, not fewer. But here is where things shift. Japan is not pulling back because of U.S. risk. Japan is being pushed by currency stress. That distinction matters, because it means the driver is external to the U.S. system. It cannot be controlled by U.S. policy alone. And when pressure is external, it tends to persist longer than expected. This is the part most analysts stop at, supply and demand. But the real story is deeper. The surface story is Japan might sell treasuries. The real story is global liquidity is tightening at the exact moment U.S. financing needs are expanding. That combination has only shown up in very specific periods: late cycle environments, pre-adjustment phases, moments right before financial conditions shift sharply. What this means for you is simple. If yields move higher because of foreign selling pressure, it does not stay in bond markets. It moves directly into your cost of living. Higher mortgage rates, higher auto loan rates, higher refinancing costs, and it happens faster than most people expect. But hold that thought, because this is only the structural layer. The real signal comes from understanding what policymakers on both sides are actually trying to do next. Here's what the data actually shows, and more importantly, what decision makers are optimizing for right now. Japan is not trying to strengthen the yen for prestige. It is trying to stop a feedback loop. A weaker yen raises import costs. Energy, food, and raw materials are priced in dollars. That flows directly into domestic inflation. Japan has spent decades fighting deflation. Now it faces imported inflation without wage growth keeping pace. That creates a policy trap. If the Bank of Japan raises rates aggressively, it risks destabilizing its own bond market, where yields have been artificially suppressed for years through yield curve control. If it does nothing, the yen weakens further, and inflation becomes politically and economically harder to contain. So the strategy becomes targeted intervention, not to reverse the trend completely, but to slow it down and break momentum. And this is where the U.S. side of the equation becomes critical. The Federal Reserve is holding rates higher for longer to control inflation. That keeps the dollar structurally strong. It also keeps pressure on every currency that trades against it, especially the yen. So you now have two systems pulling in opposite directions. Japan needs a stronger yen. The U.S. policy stance keeps the dollar strong. That tension does not resolve cleanly. It resolves through market friction, currency volatility, shifting capital flows, and most importantly, changes in bond demand. This is the part most people are missing. Japan does not need to dump treasuries to create impact. It only needs to slow its purchases or reallocate marginal flows, because markets move at the margin. If Japan buys slightly less while U.S. issuance increases, yields adjust upward to attract new buyers. That is how pricing works in sovereign debt markets. Now layer in one more factor. Japanese institutions, pension funds, insurers, banks, have been major buyers of U.S. assets for yield. But as currency hedging costs rise, those returns compress. At a certain point, domestic assets become relatively more attractive. That is not a headline event. It is a slow rebalancing. But historically, slow rebalancing phases are where major shifts begin. The pattern is clear. Before large moves happen, positioning changes quietly. Before yields spike, demand weakens incrementally. Before the public notices, institutions adjust. And this is where it gets serious, because policymakers on both sides are not trying to win this situation. They are trying to manage it without triggering instability. But the gap between those objectives is narrowing. What happens next is the real story, because not everyone agrees on how risky this situation actually is. But the other side tells a different story. The argument is straightforward. Japan is not a threat to U.S. markets. It is a stabilizer. Even if it intervenes, the scale will be controlled. The Bank of Japan has managed currency pressure before without disrupting global bond markets. And more importantly, the U.S. Treasury market is the deepest and most liquid in the world. Here's what you need to understand from that view. Even if Japan sells tens of billions in treasuries, the market absorbs it. Domestic institutions step in. Money market funds rotate capital. The Federal Reserve still has tools to stabilize conditions if needed. The pattern they point to is recent. During the Silicon Valley Bank collapse, Treasury volatility spiked, but the system stabilized quickly. Liquidity returned. Yields normalized. No structural break occurred. So the conclusion from this side is clear. This is noise, not signal. Currency management, not systemic stress. Temporary pressure, not a lasting shift. But here is the precise gap in that argument. It assumes demand remains constant. That is the flaw. Because the current environment is not the same as 2023. Back then, the U.S. was not issuing debt at today's pace. Back then, global rates were not simultaneously elevated across major economies. Back then, foreign buyers were not facing the same currency pressure dynamics. This time, multiple forces are converging at once. Higher supply, more expensive hedging costs, stronger dollar pressure, and a major buyer facing internal constraints. That combination changes the equation. Markets do not break when one variable shifts. They adjust sharply when several variables align in the same direction. And this is where the gap matters. If Japan intervenes in isolation, the system absorbs it. If Japan adjusts while U.S. issuance rises and global demand softens, yields reprice faster than expected. The surface story says stability. The deeper pattern signals fragility under pressure. And that distinction matters because the impact does not stay in financial markets. It moves directly into your daily cost structure. Hold that thought, because this is where the situation becomes personal. This is where the macro shifts stop being abstract and start entering your household budget. If Japanese demand for U.S. Treasuries weakens at the margin, the first transmission channel is not stocks, it is yields. And when Treasury yields rise, the Federal Reserve does not directly set mortgage rates or credit card rates, markets do. That means a small repricing in bonds can move through the entire borrowing system within days. Start with housing. A 10-year Treasury yield moving even 0.25% higher can translate into noticeably higher mortgage rates. On a $400,000 mortgage, that difference can add hundreds of dollars per month in payments over time. That is not theory. That is the pricing mechanism used by lenders every single day. Now move to energy and goods. If yields rise because global buyers demand higher compensation, the dollar often strengthens. A stronger dollar lowers imported inflation in some areas, but it also tightens global liquidity. That tightening can push oil pricing volatility higher in dollar terms. And when oil shifts, transportation costs follow quickly. This is where it hits gas prices. Not instantly, but within weeks of sustained moves in energy futures. Food costs follow the same chain. Fertilizer, transport, and packaging are all dollar-linked inputs. When shipping costs rise even slightly, grocery pricing adjusts with delay. Not immediately, but predictably. Jobs and employment come next. Higher borrowing costs reduce corporate expansion plans. Companies delay hiring or cap investment budgets. That effect shows up first in rate-sensitive sectors: housing, manufacturing, and small business credit. It does not appear as layoffs overnight. It appears as slower hiring momentum. Savings and deposits are affected differently. Higher yields can improve returns on cash holdings, money markets, and short-term instruments. But the benefit is uneven. It helps savers with liquidity. It does not offset rising costs for households carrying debt. And borrowing costs widen the gap. Credit cards tied to variable rates adjust quickly when funding costs rise. Auto loans and personal credit lines follow Treasury benchmarks with a short lag. That means financial tightening does not arrive as a single shock. It arrives in layers. But here's the part most people miss. These effects do not require a crisis. They require repricing under pressure. And repricing can happen even when markets look stable on the surface. What this means for you is simple. The question is not whether Japan sells treasuries in large size. The question is whether marginal changes in global demand begin to tighten financial conditions at the exact moment U.S. issuance is increasing. And that leads directly into the next phase, because markets are now trying to price what happens before any of this becomes obvious. This is where the entire structure either stabilizes or begins to reprice. Right now, markets are not reacting to one event. They are trying to anticipate a sequence of pressure points: currency defense in Japan, funding needs in the U.S., and shifting global demand for safe assets. Short term, 30 to 60 days. In the next 30 to 60 days, the most likely outcome is continued currency volatility without full-scale disruption. Japan will likely continue verbal intervention signals around the yen. Actual intervention, if it occurs, is expected to be measured and staggered, not aggressive. The Federal Reserve will remain focused on inflation stability, meaning rate expectations stay elevated. That keeps upward pressure on the dollar. Result: yen remains structurally weak but actively defended. Treasury yields fluctuate within a tightening range. No single shock event dominates, but volatility increases. Probability weight: 60% stabilization with pressure, midterm, 3 to 6 months. This is where divergence appears. Two clear paths emerge. Scenario 1, controlled adjustment, 55% probability. Japan manages the yen through intermittent intervention. Treasury selling remains minimal and indirect. U.S. yields rise gradually due to issuance, not foreign liquidation. Markets adjust slowly, but without breaking trend structures. Scenario 2, passive tightening cycle, 45% probability. Currency pressure persists longer than expected. Japan begins reallocating marginal reserves more aggressively. Foreign demand for treasuries softens at the same time U.S. supply increases. Yields move higher faster than consensus forecasts. This is not a crisis scenario. This is a repricing cycle, where expectations reset faster than policymakers can guide them. And this is where the system becomes sensitive. Because when yields adjust faster than economic data, financial conditions tighten before the economy reflects it. That gap is where surprises emerge. The key signal to watch is not headlines from Tokyo or Washington. It is the direction of Treasury demand at auction levels and the pace of yen stabilization efforts near intervention thresholds. If demand weakens while issuance rises, yields will not wait for confirmation. They will move first, explain later. And that is the pattern we have seen before major financial regime shifts. Not collapse, not crisis, but silent tightening that only becomes obvious after it has already changed behavior across markets. What is happening between Japan and U.S. debt markets is not isolated. It is part of a larger adjustment in global liquidity, where currency defense, sovereign funding, and interest rate policy are all interacting at the same time. Most people will only notice the outcome after it shows up in mortgages, credit costs, and investment returns. But the signal is already visible in the structure. And the real question is not what happens if Japan sells treasuries. It is what happens when the world realizes there are fewer automatic buyers left in the system than there used to be. That is the tension worth watching. If you want more deep analysis like this, subscribe and stay ahead of the next shift before it hits the headlines.